Bankole Odusanya, the head of fixed income trading at UBA, now joins me to discuss what to expect from the Nigerian capital markets this week. Bankole, a pleasure to have you join us on Closing Bell West Africa for this conversation. Now, I'd just like you to bring us up to speed on your assessment of the play within the market so far this week.
The fixed income market started the week very quiet, and this was simply due to low system liquidity. Funds were very tight given the CRR debits that the central bank took out last week. But upon the announcement of federal allocations on Wednesday and the view of most traders and participants in the market of incoming bond coupon on the 2028 bond on the 23rd, which was on the weekend, but we expect that money to come in on the 24th. There were some activities on Wednesdays and Thursday, and today also. So the resistance level at 4% for the secondary market treasury bills was broken. We've seen more deals at 3%, 3.5% levels at the secondary market. So 3% has come to stay. Initially, there was some level of resistance at 4%. At these low levels, some participants would rather look for other sorts of investments. Like we have seen some more activities on the Nigerian Stock Exchange, and we've seen that some investors also are asking for more by way of 4 and 5% deposit rates for term deposits. So right now, it's not looking good and very attractive for the fixed income sector.
Bankole, I'm aiming for some clarity here now. Are you saying that the losses of the fixed income market might be the gains of the equity space?
Oh, yes. With 3%, at 3% yield and return levels, there are some stocks, especially the banking stocks, that are doing well, not just with capital gains, but even on returns on investment. If you look at dividend yield of certain stocks, you'll find out that they are still within 7 to 10%, and there are several other stocks also with double digits by way of dividend yield performance in the last 6 years. If you check their average, I won't be even mentioning likes of MTN or Bankole Cement, but for banking stocks in particular, you can see that their dividend yields range from between 7% to double digits. So it's not just a play of capital gains here; it's a play of returns on investment. So that it's a reality. That's the reality of the market right now. 3% is not very attractive on the table side. And then on the bond side, we have seen yields drop to as low as 6%. And then for 2050, 2045, 2035 bonds, these are very long-term bonds, are also trading at 9% levels. So the debt management office right now is borrowing cheaper compared to what it used to borrow at levels where they used to borrow at 13%. So it's just a minimal reprieve. This may not necessarily change the challenge at hand, which is debt servicing being as high as the revenue of the nation. That ratio is actually worrying, and it's still a space to look at by the Ministry of Finance.
Now, Bankole, all week I have heard analysts describe activities within the fixed income and treasury bill space using the adjective quiet and slow as well, you being the latest of them all, of course. But now I'm looking at, obviously you said the yields trajectory do not support investors' interest within that space. But what activities can we see that can actually spur interest? For example, did the latest FAC allocations move investors' sentiments in the positive direction as far as you're concerned?
Okay. Additional federal allocations and the coupon expected on Monday will simply increase demand by way of additional liquidity. Should the debt management office or the central bank increase supply of securities by way of OMO bills, Nigerian treasury bills, or bonds, if they were to double up on volumes issued, we will see increase or a spike in rates. But we do not see that on the horizon right now, as the debt management office is more concerned about the amount of debt in issue and then the cost of servicing this existing debt, which is as high as our revenue. So on the short term for this year, we do not see the debt management office budging at all. We'll see them continue to borrow at these low levels, 2050 at 9%, 2045 also at 9%, 2035, they're all at 9%. We saw an uptick on the 2026, but it looked more like profit-taking on the short term. The yields are back at 6% offer at the secondary market, and we see this continuing into next week. Basically.
Okay, Bankole, we are fast running out of time, but just very quickly give us your summative outlook for the market in the immediate term.
Besides federal allocations coming in and coupons coming in, popping in once or twice in a month, generally the system tightening of the central bank has taken out so much liquidity by way of CRR and OMO issuances to the extent that very few funds are available to stimulate the trading sector of the debt side of the market. We're seeing more participants shifting towards the Nigerian Stock Exchange on the equity side. On the bond side, we are not seeing FPIs coming as it used to be. So it's one more participant taking off the market besides the local corporates that were taking off the OMO market. So basically it's quiet due to illiquidity and reduced participants from FPI. Going into next month and next quarter, we expect the bullish trend to continue simply because the few funds available will be chasing few securities available also.